Does Elliott wave theory actually work? Few methodologies in technical analysis polarize the trading community as deeply as Elliott wave theory, EWT. Developed in the late 1930s by Ralph Nelson Elliott, the theory posits that financial markets do not move randomly but rather in repetitive, rhythmic cycles driven by mass human psychology. To its devout practitioners, it is a master key that unlocks market structure, predicting major turns with uncanny mathematical precision. To its detractors, it is little more than financial astrology, an unfalsifiable, subjective exercise in hindsight bias. Does Elliott wave theory actually work? The answer is not a simple yes or no. Instead, it lies in understanding what the theory truly is, a highly sophisticated framework for parsing crowd psychology and managing risk, rather than a crystal ball for predicting the future. The core blueprint of Elliott wave theory. To evaluate whether the theory works, one must first establish what it claims to map. Ralph Nelson Elliott observed that market trends progress in a distinct fractal pattern, meaning the same structural formations appear on macroscopic, yearly, and microscopic, minutes, charts alike. The bedrock of EWT is the 8-wave cycle, which consists of two primary phases, the motive, impulsive, phase, a 5-wave structure, labeled 1-2-3-4-5, that moves in the direction of the primary trend. The corrective phase, a 3-wave structure, labeled ABC, that moves counter to the primary trend. As shown in the diagram, waves 1, 3, and 5 advance the trend, while waves 2 and 4 serve as brief, internal corrections. Once the 5-wave impulse completes, it triggers a broader, multi-wave corrective move labeled A, B, and C. To keep analysts grounded, Elliott established 3 ironclad rules that must never be broken when identifying an impulse wave. Rule 1, wave 2 can never retrace more than 100% of wave 1. Rule 2, wave 3 can never be the shortest of the 3 motive waves, waves 1, 3, and 5. It is frequently the longest. Rule 3, wave 4 can never enter the price territory of wave 1, except in highly specific, diagonal triangle, exceptions. If any of these rules are violated, the count is invalid, and the analyst must re-evaluate the chart. Why successful traders use it anyway? Despite academic skepticism, a vast community of institutional fund managers and professional swing traders rely heavily on EWT. If the theory is unscientific, why does it persist, and how do people make money with it? The answer lies in understanding that EWT is not a predictive system, but a diagnostic tool. It provides a map of the market's current location, allowing traders to execute structural risk management. 1. Superior risk-to-reward ratios. The greatest practical asset of Elliott wave theory is that its 3 core rules establish immediate invalidation points. Imagine a trader who identifies what they believe is the start of a wave 3 rally. They buy at the bottom of the presumed wave 3, placing their stop-loss just a single tick below the origin of wave 1. Because wave 3 is typically the longest and most aggressive phase of a market cycle, the distance to their profit target, the peak of wave 3 or 5, is massive compared to the tiny distance to their stop-loss. Even if the trader's wave count is wrong 60% of the time, a risk-to-reward ratio of 1-4 or 1-5 on their winning trades ensures they will remain highly profitable over the long run. The theory works not because it accurately predicts the future, but because it clearly dictates where to get out if you are wrong. 2. Contextual awareness. Most technical indicators, like the relative strength index or moving averages, are lagging and offer zero structural context. They can tell you if a market is overbought today, but they cannot tell you whether that overbought reading is happening at the start of a massive macro bull run or at the exhausted tail end of a multi-year trend. Elliott wave provides this missing macro context. It helps a trader recognize when they are swimming against the primary tide, preventing them from shorting a strong market prematurely or buying a topping asset when retail euphoria peaks. The scientific and statistical reality. When subjected to rigorous statistical analysis and academic scrutiny, Elliott wave theory faces major hurdles. For a trading strategy to work in a scientific sense, it must be objective, quantifiable, and backtestable. Point 1. The hindsight bias and subjectivity. The primary critique from quantitative researchers is that Elliott wave counts are notoriously subjective. Give a single chart to 5 different Elliott wave analysts, and you will frequently receive 5 entirely different wave counts, because the theory allows for a dizzying array of complex corrective structures, such as double zigzags, expanding flats, combinations, and running triangles. An analyst can almost always adjust their labels after the fact to make the chart fit the theory. This makes EWT difficult to program into a rigid, automated algorithmic backtester. If a theory cannot be objectively backtested over thousands of historical data points, it fails the strict definition of empirical scientific validation. Point 2. The fallacy of the Fibonacci obsession. Elliott wave theory relies heavily on Fibonacci ratios to predict the targets and depths of waves. For instance, wave 3 is commonly expected to extend to $161.8% of wave 1, while wave 4 frequently retraces $38.2% of wave 3. While these mathematical relationships occur frequently enough to stun observers, quantitative studies show that they do not hit these exact percentages with statistical consistency across all assets. Critics argue that when an analyst uses a dozen different Fibonacci tools alongside multiple alternative wave counts, one of them is bound to catch the turning point by sheer coincidence. The psychological underpinnings. The reason Elliott wave advocates argue the theory works is that it is fundamentally built on crowd psychology. Markets are driven by greed, fear, hope, and despair. Because human nature remains constant, the footprints left by these emotions on a price chart naturally repeat. Wave 1 represents an initial, quiet recovery where smart money starts buying, though the broader sentiment remains deeply bearish. Wave 2 is a sharp pullback as the remaining bears try to push the market down, but it fails to make a new low, signaling a shift in momentum. Wave 3 is the explosive phase. The crowd realizes a trend change has occurred. Fundamentals improve, volume surges, and price accelerates. Wave 4 is a profit-taking pause, characterized by complex, choppy sideways movement. Wave 5 represents retail euphoria. The public piles in, driven by FOMO, fear of missing out, creating a classic blow-off top even as institutional divergence begins. The ensuing ABC correction systematically dismantles that euphoria, shaking out late buyers before the next major cycle begins. The verdict: does it actually work? If you treat Elliott wave theory as a rigid forecasting mechanism that guarantees a specific outcome, it does not work. Financial markets are complex, adaptive systems influenced by unpredictable macroeconomic shocks, geopolitical events, and liquidity shifts. No geometric pattern can override an unexpected central bank interest rate decision or an overnight black swan event. Ultimately, Elliott wave theory works best in highly liquid markets with massive human participation, such as major forex currency pairs, heavily traded commodities like gold and crude oil, and broad stock indices like the S&P 500. In these environments, the mass psychology required to generate distinct fractal waves is most potent. For the modern trader, the most effective approach is to avoid dogmatic devotion. Do not look for the perfect wave count. Instead, use Elliott wave to build a flexible framework of alternative scenarios, use its rules to manage your risk tightly, and let the market's structural order work in your favor. The fallacy of the Fibonacci obsession. Elliott wave theory relies heavily on Fibonacci ratios to predict the targets and depths of waves. For instance, wave 3 is commonly expected to extend to $161.8% of wave 1, while wave 4 frequently retraces $38.2% of wave 3. While these mathematical relationships occur frequently enough to stun observers, quantitative studies show that they do not hit these exact percentages with statistical consistency across all assets. Critics argue that when an analyst uses a dozen different Fibonacci tools alongside multiple alternative wave counts, one of them is bound to catch the turning point by sheer coincidence.